Hey guys, welcome back to another video by Fully Informed Trade, or Fitrade for short, knowledge for everyone. My name is Alex Cho, and today I'm just going to go ahead and analyze the market. So all introductions aside, let's go ahead and get down to the bottom of it. First of all, the Dow Jones Industrial Average has closed again positive for three consecutive sessions. They aren't very major moves to the upside. However, we are trading into the upper area of the November high. Keep in mind, though, that we are having a European summit meeting right now, and again, depending on how those talks work out, will basically determine the future of both the bond and stock market at the same time, along with commodities as well. Now, with the way things are positioned, everyone is anticipating a positive result. The only problem is that, well, it's not really a problem. It's a case of worst scenario. If we get a bankrupt economy, or not really a bankrupt economy, but if one of the major European economies go bankrupt, a lot of banks will lose a lot of money. Now, how much money? Well, in the case of Greece, if Greece were to declare bankruptcy, it would relieve itself of $800 billion in debt. But who loses out on that $800 billion in debt? Who do they owe their money to? Somebody. But chances are the vast majority of the money was lent by the citizens of Greece. Now, automatically, that causes rapid deflation. And rapid deflation means recession, essentially, because deflation and recession depression kind of go hand in hand together. Okay, when you're expecting interest payments from the government and you no longer receive your interest payments, that reduces your income. That reduces how much money you're going to receive. That has a negative impact on your net worth. And you automatically lose confidence because all the money you saved up in the form of Greek treasury bonds are gone. And the banks that also lent money to the Greek government will lose billions upon billions of dollars. Okay? Right now, this is a confidence issue in the European government. Because if the European government can regain our confidence on Wall Street, if they can convince us that they can pay us back at some point in the future without bankrupting themselves, we can keep this going. We can buy into some form of confidence. Even though the economy may slow down over the short term in the European economic zone, even though they might experience the short-term depressionary moment where their excessive spending no longer buffers their economy, that they have to put up with added pressure in the form of tax increases and in the form of job cuts and cuts on spending, which will impact a lot of middle-class Greek citizens, because their public sector jobs will be gone. Because when the government cuts spending, you're going to cut back a lot of public sector jobs. And then when you increase taxes, you hurt the richer Greek populace. So not only will the rich and the middle class and the poor will all be hurt, but the middle class and the rich will be hurt the most. So the worker bees, the middle class, will be hurt. They're going to have less money to spend, and when they spend less money, the rich get hurt because their businesses earn less money. And let's also not forget, this Greek government has to raise their tax rate on both the higher end and the lower end and the mid end. So all around, there's going to be they're raising taxes, and they're cutting back public sector jobs, and they're cutting back social benefit programs, which will contract spending and it will contract the economy as a whole. But that is much better than an outright bankruptcy, because we on Wall Street will lose tons of money. Our clients will lose a ton of money. Our banks will lose a ton of money. And it's not just Greece that matters. This is the first time in modern history, or in the modern era, post 1900s, where we have a whole United Nation, we have a global union, essentially, or some form of it, a united government or a united front. And the prospect of war has gone down. But the real agenda here is, what about the money? Okay? Because this is the first time where a whole block, or two blocks, that represent half of the world economy are going to go through austerity. It's like a period of time where everything looks ugly, right? Because it's like walking through, let's say, the Queens in New York before eventually arriving at Manhattan. Because the Queens is the narrow, ugly corridor of New York. And then eventually you get to a point where things are rosier and nice, I assume, really, really nice prosperity, I guess, at the very end of it. You go through the Queens, you know, you might even live in the Queens, and eventually you work really hard, eventually you earn your stripes and badges, and you become a Manhattan resident, I guess. This is really hard to explain, but the main point I'm trying to bring out is that we are going to go through a really, really tough time. But if we get across that point in time where the governments are able to be paid back, the citizens are able to be paid back, we get to a point where positive balance becomes a true reality, the future is much brighter because we have reshaped our expectations to be more realistic, to address not what we can do in the 5 or 10 years to fix it, to fix things in the short term so it will only work for the next 5 or 10 years, but we fix the fundamentals of our economies, both in Europe and the United States, so that we have a brighter future ahead of us for the next century, so that we can rebuild upon something that can last much longer. Because government is an institution that also spends money, just like any citizen. But it's on a much larger scale, and therefore we have to factor in the impact these governments can have on our lives. Because in the end, the United States government and every European government is a humongous institution that we, the citizens of those countries, collectively are responsible to and are tied to as a community. And when those governments lose money and they don't pay back that money, a portion of every single citizen has gone into that endeavor in some form or some shape. And 20 to 30% of the United States money, 20 to 30% of all the money we earn goes to the United States government. So 20 to 30% of the United States is us. It's our pocketbook. And when 20 to 30% of the collective buying power of the United States is being misappropriated, it will impact us in some way, in some form. Just like it does for Greece, just as it does for Spain, just as it does for Italy, just as it does for Germany and Japan. It doesn't matter. We are a community, and we collectively impact the world. And we, as a government, or as a governing body, as a government, our governments have been irresponsible fiscally, and therefore we have to collectively take responsibility for that through short-term losses, by accepting over the short term economic doubts, economic downturn, economic recession, so that we can have a brighter future 100 years down the road, or over the course of the next 100 years after suffering short-term losses over the next 10 to 15 years. I think we'll have a much brighter future, but for right now the outlook remains negative, and we have to acknowledge the negativity coming out of both out of the United States and Europe. Okay? Volatility index is going up because things in Europe aren't as rosy, because whether they default, whether they go through austerity, or whether they do a mix of default or austerity, or whatever case scenario that we may predict coming out of Europe, they are all negative to one extent or another. And because of that, I am a pretty big bull. I'm very bullish, and bullish means positive, okay? When I say bullish, I mean positive, because I think this stock will go higher. Bullish people make money on when the stock goes higher. So when I'm saying bullish, I think the volatility index will go higher. So therefore, I think the volatility index will go higher, and therefore I can anticipate the volatility index to make us money so that we can benefit even if the economy goes into a downturn. We hedge our losses. Moving on, the silver spot. Silver is a very bad hedge, because if in the event governments default, governments do a partial default, where the government spend less money, they go through austerity, it's still deflationary, and deflation means less money to go around, less free-floating currency in proportion to any commodity will cause the value of the commodity to drop in proportion to the shrinkage in the currency. Because when we experience a monetary decelerating effect where we contract our stock currency, that means less currency to go around to buy silver and gold. That reduces the accelerating effect of buying, and we collectively have to pull back our buying, and therefore when there are less buyers and sellers, the price of any commodity will pull back, and that goes for both silver and gold. Now, if the European government decides to just throw a bunch of money at the problem and they don't fix the core issue, gold will go higher. And that's the bet everybody is making right now. Everybody is expecting the governments to act irresponsibly again. And either way, if the governments kick the can down the road and they act irresponsibly and they decide that, oh, it's okay for us to throw more money at the problem rather than figuring out a longer term solution, the moment that happens, gold will go up over the short term, but over the long term, you're going to see gold crash. Perhaps maybe 3 years down the road, gold will be trading at $2,500 per ounce. But we're still at record deficits in Europe. We still have record deficit spending in both Greece, Italy, Spain, Portugal, and Ireland. We had never addressed the original problems. All we did was give these governments more money so they can waste more money. If that happens, over the short term, you can expect a short-term asset bubble, but over the long term, you can expect even dire consequences than what we are facing now. Okay? The European-Japanese yen is continuing to go down because European banks are diversifying outside of the euro and into the Japanese yen because the fundamentals of the Japanese bond market are much better than the fundamentals of the European bond market. Because the likelihood of the Japanese government being able to borrow based on the stock of credit is much higher than the stock of credit available from the European banking standpoint of lending to the European governments, because European governments are having a hard time raising money at bond auctions, therefore the bond interest rates are so high. Okay, Philip Morrison. I want to talk about stocks right now and the different asset allocations, but I don't have enough time in this video. Take care, folks. I hope the best for you guys in the coming future, and good luck on your trading. Take care.